everybody. Thank you for tuning into our vlog. My name is Gina Bovin.
And I'm Bill Bernaducci.
We're with Bovin Wealth Management Group. First and foremost, I hope you and your family are well, safe, and staying connected during this difficult time. I want to thank you for your questions, and I think we should just probably get right into it.
Yeah, we thought we would do a little fireside chat to discuss your questions, come up with some answers, and also discuss market conditions and market outlook. So the first question that we'll go to is, when is the market going to reach a bottom?
I think that's what everybody wants to know, right? We're starting to see the market recover a little bit today and yesterday. But it's important to remember that bottoming is a process. We are watching 5 key indicators which are going to help us determine if we're getting close to a bottom.
And these are key signals that we're looking at in a process of determining, our proximity to that bottom.
That's right.
So the first key signal that we're looking at is, has the market priced in a recession? Are we in a recession?
We say yes. We've seen the market decline 34% in the past 30 days. And it's actually the fastest decline that we've ever seen. So we are going to talk about a couple of milestones we've reached during this tumultuous time. But we say yes, we can check that box. We think the market has already priced in a recession.
So the second key signal is negativity, negative sentiment.
Right.
Where are we in that with that signal?
What we're following is called a fear and greed index, and we're seeing that negative sentiment is at all-time highs. Sounds like bad news, but the closer we get to throwing in the towel and investor capitulation, the closer we are to a bottom. We actually saw the most calls come into our office so far on the lowest day of the year, which was Monday, March 23rd. And it's really important that you consider staying invested for the long term, and we're going to talk a little bit more about that.
So it's not surprising. It's hard to shut down a good portion of the American economy and not have a recession or negative sentiment.
Right.
So we've checked off those 2 boxes. The next signal is a very important signal. We've gotten some advancement on that.
That's right.
And that's policy and stimulus.
Well, right out of the gate, the Federal Reserve eased monetary policy and lowered interest rates up to another historic low, 0%. So that happened. We woke this morning and we're finding they're making some progress in Washington.
Yes, so the White House and the Senate have reached an agreement on the largest rescue package in history. So we are discussing a series of historic milestones, a historic downturn, and a historic market reaction, and a historic stimulus package in response.
Even greater than the Great Recession of 2008.
Yeah, we're looking at a $2 trillion stimulus package that is going its way through Congress and likely to be approved and
hopefully by the time you're watching this.
And so we've checked off that box, but maybe we should have put a half check.
Okay.
Because we're not there yet.
That's right.
Completely.
Right.
And there's also some confidence that we have to have in knowing that this stimulus package is going to work.
That's right.
So that could take some time too.
Right. Mm-hmm.
So we've got the box checked off, but we're also monitoring.
That's right.
The next key signal is visibility or data as to the severity or the length of this recession.
Right. And that is something that we're watching. Tomorrow's going to be a big day with unemployment claims. We're expecting over 1.5 million unemployment claims to have been filed. That's a big number. It could move the market if it's worse, and perhaps it might be better. So tomorrow's a big day. We're also looking at other leading economic indicators, and that would be like consumer spending and consumer confidence, business confidence. I like watching consumer confidence. Whenever we've hit a rough patch in the economy, it has been consumer confidence, and really consumer spending.
Sure.
That has really gotten us through the hump. I think consumer spending is going to be important and going to be big because we have all the pent-up demand. We're all sitting home, can't go to restaurants. A lot of us are, itching to go get our hair done, go out to eat, go meet our friends, have a few drinks, travel again. So that could be something to watch.
So we haven't checked off the box for that signal.
That's right.
And we have another historic number that could be coming out just tomorrow is in initial unemployment claims. So we're watching that.
That's right.
Now the next key signal is, have we reached a peak in the coronavirus or COVID-19 cases?
And so I don't necessarily know that we have to reach a peak, as it is that we need confidence on when we're going to reach a peak. And if we follow China and South Korea, hopefully the U.S. will reach a peak mid to late April. But that is the big question mark, and I think that this is really going to have an impact on the market.
So China in particular, has had a 2-month head start. They've been dealing with this crisis for a lot longer time. They seem to have data that indicates that they have flattened their curve.
Right.
And we've gotten some good information relating to some lifting of restrictions in China, right?
Lifting travel, the travel ban.
Right.
So
some of that is being lifted in China and in Wuhan and the Hubei province. Those restrictions are soon to be lifted, and we could see the release of the lockdown in Wuhan by, let's say, sometime in April.
Right. So I think the question is, if we don't know if we're at a bottom, then what's the next question people want to know?
So then the next question is, should I get out of the market now and get back in when it gets better?
What do you think I'm going to say?
I know your answer.
Okay, so what's important is time in the market, not timing the market. And it's very important that you have a buy and hold strategy, and you probably have heard this time and time again. And one of the reasons it's important is because sometimes we retest the bottom, we retest the lows of the market. So if you get out of the market and then you get back in after it looks like it's going to recover, we could retest those lows. You can actually lose more money and whipsaw your account than if you had just stayed in the market.
Right. And there's also, in addition to panic selling, there's panic buying.
Yes, and so it's not necessarily getting out of the market, but chasing the market on the way up has been investor behavior. And we do see that it's really investor behavior that has a big impact on returns, and we're going to look at that.
So timing the market can be a costly strategy.
Absolutely.
And I just wanted to refer to another slide that we put together with respect to timing, and if you could review that.
So the slide behind me shows that if you had stayed in the market from 1990, you would have made on an average of about 7.7%. However, if you were out of the market on the biggest day, you would have sliced your return to 3.9%. That's almost in half. If you missed the 2 biggest days in the market, you would have done even worse. You would have made 0.8%. And if you missed the top 3 best days of the market, you would have been in the red.
Right. So let's talk about this from the perspective of the average investor.
Mm-hmm.
All right. So human behavior and timing and getting in and out of the market
Emotions.
can impact market
That's right.
returns on their accounts.
Right.
And there has been some studies on average investors versus just buy and hold strategies in different asset classes.
Right. So what we've seen over the long term is that the average, well, let's call it an asset class. An asset class is really like a sector or type of investment. It could be real estate, it could be gold, it could be small cap or large cap stocks. But if you look at asset classes on a buy and hold strategy, and if you look at individual investor returns, you're going to see that the individual investor over the long term has only made about 1.9%, whereas other asset classes have done done so much better if you had bought and just held them. And that's because it's so difficult to time the market. When you try to time the market, you need to be right twice. You need to know exactly when to get out, but more importantly than that, and probably more difficult, is you have to be right the second time and knowing when to get back in.
Sure.
So we appreciate your time today. We'd like your feedback. We'd like to hear more questions.
Well, in sum, you should stick to your plan. Right?
Yes.
That's the
Yes.
that's the takeaway.
And if you're home and you haven't filled out your financial fact finder that we sent you to do a financial plan, we do take market volatility into account when we're looking at your retirement income. So be in touch with us. I want you all to stay safe, stay well, and we think it's prudent if you stay invested.
Thank you.
You.